want to start by saying hello to my Taiwan viewers. I have been to Taiwan a couple of times, and I had a wonderful time there. It's nice to be back, at least on a video. The CAPE ratio stands for Cyclically Adjusted Price-Earnings Ratio. It's an improvement over the standard price-earnings ratio by extending the length of the denominator, the earnings. Instead of measuring earnings for 1 year, we measure them for 10 years. And there's a very good reason for that. The problem is that 1 year earnings are too volatile. They jump around a lot. Smoothing it over 10 years makes the ratio work better for its intended purpose. The history of my thought about this is, first, there was an intuitive grasp of the notion that stock prices jump around an awful lot. They look too volatile. So something is wrong, I thought, with the efficient markets theory that the stock market is perfect forecaster of anything. If it's a perfect forecaster, why does it jump around so much? And then I thought, well, okay, if it's not right, then it must be somewhat forecastable. And I wondered what would forecast it. And it just led me to think something about, there should be some measure of whether the stock market is too high or too low. The CAPE ratio has some ability to forecast stock prices. Not hugely accurate, but it's definitely there as a factor. So when the CAPE ratio is high, it would be a sign to reduce exposure to a sector that shows this high CAPE ratio. Or when it's low, it would be a sign to increase exposure. But it's not so sound and solid a forecaster that it would mean you should go all into the lowest CAPE. It's not that accurate. So you want to diversify, but you want to tilt toward low CAPE sectors. We find that a investment policy of tilting toward the low CAPE sectors, but still diversifying somewhat, is actually a very effective investment strategy, especially for the long run. CAPE is not accurate in measuring next month's or next quarter's returns. It's for long-term investors who have patience. And for those investors, we found that it works. The Barclays people and I developed something we call relative CAPE, which is CAPE which is adjusted for the average level of CAPE for the last 20 years. And this works better. So yeah, it's a small but significant improvement in how we can use CAPE. Well, overall, the U.S. market is expensive. CAPE is in the high 20s. Europe is less expensive. On the other hand, that isn't an implication that you should avoid the U.S. entirely and go all Europe. Again, there's an importance of diversification. But also, sectors within the U.S. are not always expensive. So if you invest in the low CAPE sectors in the United States, you're still doing a good strategy of investing. The bond markets worldwide are in an anomalous situation. We have never seen such a protracted period of low interest rates, both short-term and long-term. And in fact, real rates are often negative, so that you are guaranteed a negative return after correcting for inflation. This reflects some fundamental factors that are driving the world economy at the present time. It's called the new normal, and there's a question about how much longer it will continue. The very high long-term bond prices are, by some accounts, a sign of a bubble in the long-term bond market. I'm worried about that, but I'm not sure that it will end anytime soon. This may be a long period of low interest rates. So it just makes long-term bonds look unexciting as an investment at the present time. I want to take this occasion to thank you for interviewing me and putting me in front of the people of Taiwan again. Last time I visited, I had a wonderful time, and I would like to visit Taiwan again soon.